featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities, and if you have any questions about the share or bond market, and preferably the bond market tonight, please pick up the phone and give us a call on 1300 30 34 35. The email is yourmoney@skynews.com.au. And joining me on the panel tonight is Simon Eagleton. He's Head of Investments for the Pacific area for Mercer, and Victor Rodriguez, Head of Fixed Income at Aberdeen. Welcome, gentlemen. How are you?
Thanks, I'm well, mate.
Thanks. Good weeks?
Terrific.
Now, Mercer, I know who Mercer are. When I go there, there's so many different entities under the Mercer banner. So, in terms of for the viewers at home, can you tell me a little bit about Mercer and the size of it, the way that it goes about its business, and who its customers are?
Sure, Mark. Thanks. Mercer's a professional services firm. We operate in 42 countries around the world in the areas of health, talent, retirement, and investments, which is the area that I'm responsible for.
Health, talent.
Yep.
What's talent?
Talent is about helping our largely corporate clients getting more out of their people. So it's human capital consulting. It's about rewards, incentive structures.
So productivity. You're not the guys that go around saying sack the guy on the left. I mean,
no, it's not so much that.
No, right. Just want to check. And business has been good. It's a growing business.
It's terrific. In Australia, we have 1,200 professional staff. Of particular relevance, I think, to your viewers, Mark, is the work we do in the superannuation space and the investment space. So Mercer offers a corporate superannuation master trust, and we also provide a whole suite of multi-manager funds as well.
And what does that mean, a corporate master trust? How does that work out in practical terms? Give me an example of what that would mean.
So, Australian company, basically, it's quite an onerous environment now to operate your own super fund for your own staff. And there's been an enormous wave of essentially outsourcing that activity to service providers like Mercer.
Is that driven by the fact that it's become more complex and you know the 500 staff, there's a certain amount of money, and you have, as a director, you've got all these obligations, and you think, let's just move this to a professional, and they can come back and give me the results for the because I remember how we changed who we could choose in super. Is that drives that conversation a bit?
I think that's part of it. I think one angle is really the cost of running your own fund. The other is the onerous obligations on the trustees of those funds, the legal obligations, and particularly with the significant reforms that we've seen in the superannuation industry, and most recently, of course, is the stronger super reforms. And I think we're seeing the final wave of outsourcing. Large corporates, complex schemes with defined contribution and defined benefits and pensions, very difficult. And that we're really facing the last phase of the next few years, I think.
We can talk about these defined benefits later on, because it's a really interesting problem that the markets have created for themselves by giving people certainty. They've given themselves liabilities that they need to manage. And Aberdeen, Vic, massive organisation that I don't think enough people know about the organisation. I know that when I read stuff in the paper about them, they are really dynamic, a global entity. But it's when people think of fixed income, they tend to think of PIMCO and people like that. It's part of the growth strategy must be to get your name out to all these organisations. So tell me about Aberdeen.
Absolutely, yeah. Just to give you a summary on Aberdeen, we're a FTSE 100 company. We've got over 300 billion in assets under management. Unlike Mercer, we're very focused just on one thing, managing people's money. We've got 31 offices around the globe with nearly 2,000 staff. In Australia specifically, where, like you say, our brand perhaps isn't as strong as maybe some others, I guess primarily our business is institutional, but in the last few years we've really tried to grow that retail presence, and so we're diversifying our business. We've got about 13 billion in fixed income under management in Australia alone.
13 billion.
13 billion, yes, and that's across the range of fixed income asset classes. So hopefully we get a chance today to talk and educate a little bit, the audience a little bit about how you can invest in certain different asset classes, whether it be fixed income, high yielding assets, inflation-linked bonds, total return type funds.
So you can segment that. You can if I'm an investor with $100, I can put it in a different $1,000, I can put it into a different investment vehicle?
Absolutely, yes. So, and that goes across a range of asset classes. So we obviously manage equities in Australia as well, the traditional small cap equities, for example. But in fixed income, we've got an inflation-linked bond fund. We've got a sort of more flagship Australian fixed income fund. We've got a total return fixed income fund that looks to try and remove some of the interest rate risk that we can talk about. And we've got a diversified fund that looks to include emerging market debt, Asian fixed income, the broad global sort of gamut of fixed income products.
Moving into the retail space, how do you access Aberdeen in retail? What's the platform that people use?
Yeah, so really in terms of accessing Aberdeen, we've got exposure to a number of platforms. I could pick a few, but things like the AMP platform, the Colonial platform. So basically it's about getting on those platforms. We're not marketing admittedly directly to mums and dads, but they're able to access that, and
we planner.
Exactly, and the education process of the broader financial planning community has been key to trying to get that growth in the marketplace.
You must agree that education is the key in a lot of these different, whether it be talking to an industry super fund or whether it be talking to a person that reflects a corporate trustee. Education is the key to all this at the moment, isn't it?
Look, I'm going to disagree with you there, Mark. I think
you want them to be dumber.
No, I just think I mean, education will always be important, but it's like a necessary but not sufficient. And I think the industry, frankly, is kidding itself if we can actually equip the Australian public to make informed choices about their retirement saving
because
investment
it's
choices.
Too vast? Because there's too many people?
Look, it's too complicated, and I think we struggle to even educate our citizens on basic finance, like how do credit cards operate, etc. Trying to make them or equip them, to know something about long-term saving for retirement.
I'm going to agree with you because I've tried to educate my wife on the credit card, and that's not working yet. So we really need to get some education on credit cards. I think that'd be a good idea. You spoke about rates, Vic.
Yep.
Tell me what you think in terms of the cash rate. I feel that the cash rate is driving all the questions at the moment in terms of currency, future performance, cash rate overseas, how we compare with it.
Yeah, sure.
Bob Catter came out saying we're too high. I love that. Bob Catter's an expert in that and the interest rate cycles, and that's great. At least he's got a view. What do you think about these cash rates?
Yeah, sure. In terms of the cash rate, look, we've had a view for some time that the cash rate needs to head lower, and obviously we've seen that, and we continue to believe that. So our view is we'll see another rate cut over the next 12 months at least. That view is premised on the idea that unemployment is heading higher. If you look at leading indicators of unemployment, things like job ads, business confidence came out this week, all relatively weak, suggesting there's more pressure in terms of unemployment going higher. We've also seen the budget this week where whilst there's no immediate pressures in the next couple of years, that the fiscal side of the equation is not going to be contributing to growth. If anything, the brakes need to be put on there given the deficits are much larger than expected.
What it is.
So monetary policy needs to do more of the heavy lifting. The one key variable, though, for rates is the Aussie dollar. Now, for 20 years, in fact longer, we've had the Aussie dollar doing some of the work for the RBA. So every time the economy needed a boost, not only did you have lower rates, but the Aussie would fall. It might make it harder to go on an offshore holiday, but for the economy, much more positive. And vice versa. When you needed sort of the brakes put on, you had higher interest rates, but you also had the Aussie dollar appreciating. The last 12, 18 months, we've not seen that. We've seen an incredibly resilient Aussie dollar.
It's been bulletproof.
Bulletproof, yes, and maybe until now. Very difficult one to call in terms of whether we see further moves from here, but certainly if the currency starts to fall to sort of that 85-90 cent range, then you start to question whether the RBA needs to cut rates further.
Simon, we've got a couple of minutes before the break. Your thoughts?
Yeah, I mean, the similar thoughts. I mean, if we're not near the bottom, we've got to be getting pretty close, don't we, Mark?
2.5?
Yeah, I mean, I wouldn't rule out further easing, but I think that the challenge that Vic's talked about is that the sort of stubborn, uneven traction of monetary policy, although we're just starting to see that on the currency, as you point out. So
it's been interesting how a lot of the cuts didn't get passed through to the mortgage belt. It started to get passed through to the mortgage belt. And I think the RBA have felt that the mortgage belt has underperformed its expectations. They would have thought, get the money and spend it, and they didn't. The consumer has become more conservative, and the RBA is trying to find what's its policy tools around trying to make that stimulus be active, spend your money. When the RBA was saying in the global financial crisis, I really think the consumer needs to balance its own budget and it needs to perform. And the consumers remembered that volatility in all markets has meant that everyone's naturally conservative. So the stimulus isn't as strong, the currency is too strong, and the RBA would be sitting there back and saying, our 20-year program is now different and I need different tools.
Well, two things I'd say. I'd agree with you completely on this idea that banks are now prepared to potentially even cut rates more than the RBA, which is complete opposite. But secondly, I would caution the idea that the last few years have been unusual in terms of saving rates of the consumer. What we saw was actually a period during the mid-90s to the mid-noughties where actually savings rates were close to zero.
Yeah.
But if you go back 95 for the previous century, savings rates of 10% are not unusual. So in that sense, I'd caution anyone who's hoping that growth might come about by savings rates starting to fall appreciably.
Yeah, that's a really good point. Look, we'll have to leave it there and we'll go to a quick break. But if you have any questions for our expert panel, please call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. Welcome back to the Bond edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Simon Eagleton, Head of Investments for the Pacific for Mercer, and Victor Rodriguez, Head of Fixed Income at Aberdeen. They're here to answer any of your questions. So please pick up the phone, call us on 1300 30 34 35, and the email yourmoney@skynews.com.au. Now we'll go to our first viewer email of the night, and it comes from Tom. And the email is, an OECD report shows that pension funds in Denmark have 80% in bonds, Holland has 60% in bonds, and Australia, lagging, has less than 20% in bonds but 50% in equities. Who is right? I bet the retired people of Denmark and Holland slept well at night during the GFC. Thank you, Tom. Would you like to respond to Tom's
I think one
commentary?
Very important difference, Mark, between continental Europe and Australia, of course, is the much more predominance of defined benefit schemes, where corporates are sponsoring those schemes, and therefore the risk of investment outcomes is very much the corporates, because they're promising fixed benefits to their membership. Unlike in Australia, of course, where Australian individuals bear the investment risk.
Yep.
And I think one of the challenges is the accounting requirements on corporates to tightly manage the finances of their pension schemes.
But to Tom's email, why does that mean they have to go into equities? I mean, I hear what you're saying, but why that? I think his theme is, as a corporate, why wouldn't you be more conservative and follow what the Dutch are doing and say, let's just buy some bonds? Give the money to big.
Well, one of the things you do give up is the expectation of somewhat less returns over the long term.
Well, Vic, your return's been somewhat less, or you want to talk?
Well, I mean, look, I guess, as we always say in this industry, past performance not necessarily an indicator of future performance. But
Chris Cuff was on this show and he said that's not true. He said past performance is an indication of future performance, because if you're hopeless before, you'll probably be hopeless going forward.
Well, that certainly holds Aberdeen in good stead then.
Good. Okay. Let's talk about...
To answer that question, I'd certainly concur with Simon's comments to some degree in terms of defined benefit. So when you're promising a certain rate of return, the idea, which is what happens in these defined benefit schemes, which are very prevalent in parts of Europe, then obviously the incentive to invest in equities where there's more volatility is reduced. And here there's a lot less of that defined benefit. But I'd also say that in equities, in this market, there are far too many incentives in terms of tax relative to other asset classes like fixed income that seem to bias it. And in 2008, because there was a reference to the GFC, the second worst performing pension fund market in the world was Australia.
Was it right?
In 2008. And think about how our economy performed relative to those of offshore. Now, again, part of it is because there was the good fortune at that time, at least, of having fixed income from defined benefit, but really it was that huge weighting to equities that we have here. So it does seem a little bit skewed, albeit I wouldn't be suggesting 60 or 80% allocations to bonds necessarily.
So we're probably needing a Keating-like treasurer to come in and do the same as dividend imputation with the fixed income market, and so let's rebalance that natural bias.
Yeah, can I add something to that, Mark?
Yeah, absolutely.
I just think Vic makes a really good point about the typical asset allocation in Australia. And I think one of the challenges we face is that without education and advice, everyone's sitting in these default strategies which are very growth oriented, very aggressive, and particularly at key sort of events as you approach retirement, where you're very exposed.
It becomes round to that advisor saying, buy this share, buy that share, and as you're taking this information, you trust those advisors and go with those shares, and probably over time, maybe the GFC has meant that you've been less inclined to follow that lead. But talk to me first about defined benefits. Your point being Europe has a much greater number of defined benefits and Australia doesn't. Now why is that? What is it what is a defined benefit for the viewers at home, and why is it Europe centric and not Australian?
Yeah, well, the key issue or key difference between the kind of schemes we have in Australia, which we call defined contribution schemes, where like SG 9%, hopefully about to be 9.5.
12, or to you know, 12 when it's.
So we put the 9% in, and what comes out the other end is whatever the sum of the contributions and the mysterious investment returns we get over our careers. We don't know what they're going to be. So it's a defined contribution with an unknown benefit at the other end. The difference with the defined benefit, which is the old school kind of benefit arrangements,
capital guaranteed,
which many of our public servants enjoy, and some, indeed, politicians as well. And that's where it's the benefit of the other end that's defined, usually as a percentage of your final salaries for so many years of service. And the risk of delivering that benefit is actually the employer, or in the case of public service, the government. So
clearly the problem with that is for the employer that we live longer than he anticipated when he offered that, and then the combination of that longevity and then trying to hit those targets, which might be 80% of your last wage growing at inflation or whatever it might grow at, and that becomes very challenging for everyone to sort of get those investment returns. I guess, does that mean that they start looking at riskier growth assets to meet the underlying liability? Is that the natural response?
You'd think so, because you think a corporate is around forever, and so they've got a long-term time horizon. You'd think they'd be very able to withstand the extra volatility of growth assets like equities, but the reality is our accounting brethren are very focused on the short-term performance of companies, quarter to quarter, and the movements in the assets that support these defined benefit plans can influence the company's earnings. And as a result, companies can't handle that volatility, and therefore it's just decided, and this is a huge trend in Europe, in particular in the US, so-called de-risking of these defined benefit pension schemes, which means it's great for his business. A lot more interested in bonds, a lot more interested in inflation protection.
We love inflation protection. So let's talk about QE. I've spoken to the viewers about QE forever. It just goes on and on. It's the worst story in the world. Vic, are you worried about it? Are you worried about QE forever, or do you think it's just a natural evolution? It'll work itself out. How do you at Aberdeen view it?
Absolutely. Well, I think the thing that one needs to worry about is when the exit strategy for QE starts to commence, and there was some talk, some articles, and certainly some comments out of the Fed starting to sort of talk about tapering and looking to eventually exit out of QE. We don't think that's imminent in any way, shape or form in the next 12 months, even though there are some positive signs in terms of US growth. And let's focus on the US for a start. Obviously, we know Japan's just joined the club in terms of QE. But in US, whilst you're seeing some positive signs in terms of growth on the consumer side, business investment not really picking up, but starting to. But you've got this fiscal drag, right? You've got the government having to save much more so than here in terms of going forward. So the growth environment doesn't in any way for us feel sustainable, particularly with unemployment still high, and any drop in the unemployment has come from people giving up on looking for a job. The participation rate coming down, which is hardly a positive signal. So in that sense, the exit of QE seems a long way off just yet. But when it does happen, investors should be rightly cautious about this idea of what can happen, and just the rumours, just the suggestion of it saw some risk aversion in recent days. Right?
Cautious or worry? I mean, what's your thoughts on QE?
Well, I think I share Vic's view that if anything, we've seen more aggressive QE. With the purchase of mortgage-backed securities, for example, in the US. So I think there's no sense anytime soon this is going to end. Having said that, it's been a very positive, hasn't it? It's taken a lot of the tail risk out of the equation, and we saw a big re-risking, which has been good for investors.
I mean, one thing I'd add too, and this might sound like it's more verging on worry than caution, but it does ring a bell what's being said right now about this wall of liquidity, right? That's sort of supporting markets, and really it's starting to turn into the sole driver of markets. 2007, 2006, we were hearing the same thing. Right? It was a different wall of liquidity. It was sort of coming through banks, off balance sheet type activity. But to that extent, that's what warrants the caution. It's just that from our point of view, that exit of QE still seems a long way off.
Yeah. Look, we have to go to another short break, but please give us a call on 1300 30 34 35 for any questions you have on investing. You can email us. The email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to the program. If you have any questions about the bond or equity market, please pick up the phone, call us at 1300 30 34 35 and the email yourmoney@skynews.com.au. Before we went to the break, we talked about the QE forever. My next question is inflation a concern for you? Is that, we get a lot of emails at FIIG around, we do an awful lot of inflation business, and the emails are driven from the fact that with so much money printing, it seems to make sense that you'll be eventually beaten with a lettuce leaf. You stop feeling the stick of all this cash and it starts to be inflationary. Simon, do I start with you? Is inflation a worry for you?
Inflation is always a worry, but it's about the time horizon that it's a worry. I mean, it is such a destructive force, and particularly for retirees, right?
Yep.
So, yes, worry, but not immediately. I think there's no sense that inflation's returning. Both the RBA and the Fed have been very clear on this. They've got plenty of headroom to...
So when we talk about this, and Vic, if you want to bump in here, when we talk about inflation being not a worry, I'm not disagreeing, but is it not a worry because it'll sit between 2 and 3%? Is that why it's not a worry?
I was just going to say, it's not a worry at the moment, but it's always, you need to always be vigilant.
But is my question is your assumption that it'll sit between 2 to 3%, so therefore it's not a worry, so it'll be 2.5%?
Well, our view actually is probably over the sort of 12-month horizon, it's probably going to be towards the lower end of that band.
Under 2?
Not under 2, but just towards the lower end of that 2. And if you look at the US last night, right, headline inflation 1.1, ex-food and energy 1.7, like Simon says, the freedom for the Fed to be acting the way it is for now, quite substantial.
Okay.
Longer term though, I think, which is to Simon's point, longer term, it's right with all this QE that investors are thinking potentially about the need for longer term inflation protection. And we know in investing, getting the timing right isn't the easiest part of the equation. So thinking about the longer term risks, they're undeniable. When you flood that much liquidity into markets, eventually the risks of inflation have to emerge. But certainly right now, both domestically and in countries like the US, obviously Japan's a non-issue, Europe's a non-issue in terms of inflation, but the risks don't seem imminent.
So what do we do? How do we hedge against the inflation that isn't at the moment benign, 2 to 3%, going to we don't know where and we don't know when? So what do we do?
Well, I think there's a couple of solutions. One is if you think about the big risk is that inflation drives down the real value of your savings, then you should be building a retirement savings portfolio that's growth oriented, that will grow over time, and that could be a whole suite of investment products and securities. If you start thinking about the specifics or actually targeting inflation, I think there's a whole lot of things to look at. Inflation-linked bonds.
Yep.
Real estate has rents linked, some parts of rents linked explicitly to inflation.
Yep.
Infrastructure, both infrastructure securities as well as if you're an institutional investor or a big super fund, they actually invest in direct infrastructure like airports and toll roads. And again, some of the revenues there are linked to inflation too. So there are things you can do over the long term to give you real returns.
Do you feel, Simon, that as a part of a portfolio generation, you might say, I'll always put 10% away for a rainy day, being an inflation hedge, whether it be an inflation-linked bond or whatever it might be? Is that a sensible approach?
I think it's not a bad idea. I think one of the things we've got to think about, and your viewers need to be aware of, is that we're going to live a long time in retirement, and it's not just price inflation we need to be worried about. It's things like health cost inflation.
Yep.
And that, history shows that is at rates much, much faster than the normal price inflation.
And so as they become more important to part of your consumer spend, your school fees haven't gone up. Well, hang on, they might go up.
Mine do.
So, okay, let's say there's an element that doesn't go up, and then all of a sudden you get into the health piece and you go to the doctor, and that starts to become a greater part of your pie, and it's grown at a greater inflationary number than the macro, like the bananas. What about you, mate, in terms of the inflation strategy? What at Aberdeen, what are you looking to do?
Well, within fixed income, clearly, as Simon touched on, inflationary bonds would seem to be the most appropriate asset class. In terms of a hedge against inflation for your income, it's almost impossible to beat, right? Your actual coupons or interest payments are linked to the actual inflation rate.
Yeah.
But I'd stress that it's an asset class where you're looking to protect for long-term inflation. These assets are longer maturity in nature, so if you're worried about inflation over the next 6 months, it's not necessarily the best asset class. I'd suggest, really, if you're worried about inflation in the very short term, given we've still got a credible Reserve Bank, cash rates, the Reserve Bank's likely to respond to inflationary pressures in cash. But over the long term, inflation-linked bonds, certainly within the fixed income asset class, seem to be very...
I ask the viewers to think of it as a Rumsfeld approach. You don't know what you don't know. So don't try and predict 6 months from now. Predict that there's a portion will be inflation. Let's hedge up that proportion as you get older, maybe put more into it as you feel more comfortable, because you've built, there's some great inflation assets that you can get around 6% for your returns if inflation's at 2.5. If it's at 2, it's 6.5, almost 7. At 2, it's 6. So I think a 6% return for most people should be, in this low interest rate environment, quite a reasonable response. How has the inflation portfolio at Aberdeen performed?
It's performed very well across our, we've beaten we tend to use this sort of flagship inflation-linked bond index published by UBS, and has consistently beat returns. I mean, double-digit returns absolute over the last 5 years per annum. Double-digit, or just barely, but about 10% returns per annum over the last...
Market. I just wanted you to say that again. It's a double-digit return in the bond market.
And I'd say not necessarily repeatable in terms of absolute returns, given where yields are, but certainly, certainly inflation-linked bonds have performed very strongly.
We have our first caller for the night. We have Peter from Sydney. Peter wants to talk to us about yields on bonds. Hello, Peter.
Oh, hi, Mark. Just a point about inflation first. You'll find if you look at the money supply in the US and elsewhere that it's not growing very rapidly because banks aren't lending. So all of the action by the central banks to purchase bonds and other securities in the market won't lead to inflation unless banks start lending. If banks did start lending, then the central banks could act. So I don't think there's really any fear of inflation through quantitative easing. And the signal for the possibility of inflation will be if the money supply starts growing, and that will require that banks start lending, which they're not doing to any great extent right now. But my real question is related to yields that can be obtained by retail investors right now in the market in a relatively riskless way. I mean, what should a retail investor be investing in right now? Which bonds precisely to give that return? What is the return? And of course, I don't want to include sort of securities that entail much risk in that question.
Sure.
Thanks,
Peter. In terms of the bonds that you could invest in that are conservative, I think there's an array, and we can talk about specifics, and retail investors have different options. The hybrid market gives you quite reasonable returns, but there's a lot of... you need to do an awful lot of due diligence on a lot of these assets. I think a conservative return is around about 5%. I really feel that there's national wealth bonds, there's NAB cap bonds, there's a lot of the old structures around that you probably get about a 5% return. Qantas just issued a bond today, and that was around about 6%. Whether it's available to all the retail investors, it's around the documentation. And I think, to Peter's question, you can't specifically say this is the one for you because you need to get a better insight into what Peter's total portfolio is. But there's a lot of corporate debt around that you'd probably get 5%. And certainly a lot of the banks in some of the old structures. If you were to talk to Peter, what would you say without having to compromise the integrity of Aberdeen?
The first observation I'd make is that it's a very different game when you're lending to a company than when you own one. And so in shares you have a normal distribution of returns, which basically means you've got your winners and your losers, and you try and pick your winners and avoid your losers. In fixed income, when you lend to someone, your aim is to get your money back and the interest rate along the way. So to try and pick winners is not the aim of the game. You're actually trying to avoid losers and diversify your portfolio. Peter spoke about banks. You don't find banks with a very concentrated pool. If you had a bank with a very concentrated pool of assets, you'd be more concerned about that bank. They're looking to diversify. So being a lender is a very different game to being an owner, and you're looking to diversify. I could highlight a BHP bond that's at 4%, or a Fortescue bond that's giving you much more yield than that, 6-7%. But those bonds in isolation create a lot more risk than if you're able to diversify your pool of fixed income assets.
You would agree that around a diversified, you can get a conservative response, but you need to have a diversified portfolio. Now we're about to go to a break, but we're going to go to you first, Victor. Before we go to a break, we'll have to leave it there. But before we do, we're going to crank up the speaker's corner, and we're going to have Victor come through for 30 seconds, and he'll tell us what the biggest issues affecting the bond market for him is. And your time starts. I'm hoping it starts now, but hang on. Now,
fixed income is often viewed in competition to other asset classes, even the name of this show, bonds versus equities. I think that misses the point. At Aberdeen, we believe you've got to view fixed income in terms of how it fits in a broader investment portfolio. Australian fixed income, for example, has consistently provided insurance in times when equities have been falling. So thinking about how it fits into a broader portfolio gives you a greater sense of the risk and return benefits.
You finished
too quick, sorry.
Far too quick. Well, that's all right. You got your point through. We'll take it to a break. We'll be right back. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. I'm joined tonight by Simon Eggleton, Head of Investments for the Pacific area for Mercer, and I have Victor Rodriguez, Head of Fixed Income at Aberdeen. And if you have any questions on bonds or equities, please call through on 1300 30 34 35, and the email is yourmoney@skynews.com.au. Peter rang in earlier and he was making some statements around the inflation, the lack of banks lending. We didn't get a chance before we entered the break to talk about that, but what's your thoughts on Peter's comments about the banks lending and inflation?
I think that comment just highlights that very much inflationary pressures are linked to growth. And so what you've seen in the US, part of the reason growth has disappointed over the last few years is you've seen a complete lack of business investment, right? Companies have been looking to sort of hoard cash. They haven't been looking to borrow. They've been looking to de-lever and really defend their balance sheets. So if you were to see the start of the return of that, which is really what the Fed is trying to engineer, let's face it, then the inflationary pressures might emerge. And whether the Fed can then be ahead of the curve in combating that inflation is what people need to have concerns about in the longer term.
Does that make sense?
That makes sense, absolutely. Look what Japan's doing.
Yeah.
Doing everything they can to create inflation.
They just want to get inflation going. And it's a natural argument. It's the argument around the banks don't lend. And then the banks say, well, no one wants to borrow at the price we need to lend it at. And so there's this problem around, there are people who want to borrow that they don't want to lend to. The people they want to lend to don't want to borrow because BHP can go to the bond market and do it much cheaper than the bank. So there is a natural convergence around de-risking everything anyway. Let's switch it up again. I want to just talk about the fees. I want to talk about the fees are at the forefront of so many investors' minds, and I think the GFC created an environment where they felt much more comfortable in questioning fees, and I feel that the politicians fed into that and said, yep, you know, everyone earns too much money. Now, I'll be honest, I met a lot of guys in financial markets that did earn too much money. They certainly didn't justify it, but other times there are some really brilliant brains who are creating some great wealth for a lot of their customers. How have you changed your business model, Simon, in terms of responding to this constant question around fees and justification for your existence to some extent?
Sure, mate. A big part of what we do at Mercer is help clients deal with it, help clients select investment managers, and fees is an obvious point, as you say. I think one of the things is you've got to understand what you're getting for the fees, and let's face it, we can get the return on equity markets, bond markets, a number of securities markets virtually for free now. Virtually for free with ETFs, with passive funds, very low fees. And so if you are paying fees, your expectation should be for outperformance of those benchmarks.
Yep, makes sense.
So what we're seeing is questioning of the outperformance, the so-called active management return, and whether it's worth paying for. Does it exist? Maybe we should get better alignment of interest. For example, performance fees. I think it's a very interesting area. I think this is an industry where, you know, it's an intermediated industry. It's a principal agent industry. We need, I think, to link performance with customer outcomes. I'm very in favour of performance fees.
When David Murray took over on the Future Fund, he was talking about too much alpha, and we paid too many fees, so they were trading too much fees. He wanted them to just be passive buyers, just buy whatever, or get their managers to not trade too much. Is that the right response, do you think, or is it more about, to what you're saying, if I pay Vic a couple of points for the bond market, we can talk about the bond market fees in a second, but if I pay you some fees, shouldn't I just look at how you perform as opposed to me making a decision on how you trade? Do you think it's more about everyone got too involved, became too many experts?
Well, I'd echo Simon's comments. Really, it's about being able to deliver for clients in terms of, as an active investment manager, in terms of active performance. So across our range at Aberdeen globally, not just in Australia, we are active managers, whether it's equities, whether it's property, whether it's fixed income. And to the extent you ask about our business model, it hasn't really changed, because by delivering those returns, we've been able to resist the kind of fee pressure that is prevalent in the industry to some degree, but it is sort of moving towards more index investing. And some some of these indices are very, very flawed. I mean, you think about a bond index. A bond index provides bigger weights to companies that borrow more.
Yeah, right.
Now, that doesn't seem intuitive that you'd want to have bigger weights to those companies. They might not be the most levered because they might have a big asset base, big cash flow base, but an index investor, whether it's an ETF or an index fund, is being forced to buy more of those more levered, or more, sorry, not more levered, but bigger borrowers. So it's very different, for example, to equities, where even there we're obviously very active in our...
Look, I must admit, I'm not a fan of the passive funds, only because, you know, index tracking and all that sort of stuff, not even just so much the floor, it just seems to be the dumbed down approach to investing.
Absolutely.
You need to say, I want an active manager, I just need to pick the right one. I know there's a challenge in that, but at the same time, that's the job you should be investing in. If you can't find an active manager, you're not comfortable, well, put the money in cash. You know,
I absolutely agree, Mark. I think it depends, though, on which asset class we're talking about. Some asset classes are what we call very efficient. There's not much ability to pick.
Such as, is that like a cash rate?
Large cap US equities as one example. You know, it's very hard to outperform the S&P 500.
Right.
Very, very hard. And if you pay active fees for that, you'll almost certainly be disappointed.
Okay.
Having said that, in some credit markets, in small caps, in emerging markets, plenty of opportunity. Securities are mispriced. You've got naive indices that, in some cases, I mean, your example, Vic, of you know, the weights in the indices to companies that borrow more. It's even worse when it's looking at countries.
Yes.
You know, giving money to places like Japan, vastly indebted countries, because they're the biggest part of the index. Very, very flawed.
You don't want to be doing that.
You don't want to be doing that. I think there's plenty of evidence that skillful managers can outperform.
I think the other thing I wanted to talk about is that around that outperformance question is industry super funds are under enormous amount of pressure to perform, and it's interesting how they're reacting. I mean, I think the growth in self-managed super funds has meant that industry funds have lost their passive investor, that people are creating more funds, and we can talk about that. But industry super funds, to my mind, seem to be talking more about taking the capabilities in-house. Is that a trend that you're seeing for your client base, or is it for other people? I don't know.
Well, it appears to be, at least at the start of a potential trend. Certainly the larger players have been doing that or moving to do that. It clearly seems to be, as well as the consolidation in the sector, sort of very cost-driven. So our concern is not necessarily the consolidation, it's just the quality of returns that may result from the kind of actions that are going on. And we talked about one, the move towards index investing. Does that actually provide more efficient absolute returns for investors?
Yeah, can I add? I think clearly, you know, investing other people's money, one should, as industry funds do, focus on the cost of production and doing that, and should drive costs out of their business for sure, because less fees means more returns for their customers.
They do a great ad, don't they?
Oh, there's
the twins, and they say, right, you know, with lower fees, this person lost a lot of money, this person made a lot of money because you paid lower fees. But that doesn't allow you to think, okay, the investment returns might have been different for all these people.
Well, the key is after fee returns.
Yeah.
Okay, so it doesn't necessarily follow that a lower upfront fee will mean an improved after fee return. So that's the only sort of thing I'd throw in there. But obviously, as I agree with Simon, it does make sense to be looking to sort of consolidate and reduce costs.
But I do think, Mark, just very quickly, I do think some of this insourcing of investment management capability can be illusory. You can cost yourself performance.
Right. Okay, look, we'll have to go to another break, but before we do that, we've got round 2 of the Speaker's Corner, and Simon, you've got 30 seconds, and it starts now.
If there's one thing that I could change about the retirement saving industry, I think we've done a terrible job of dealing with the post-retirement phase, and that is helping investors manage that things they need in retirement, which is, you know, stable, predictable incomes. It's inflation protection, and importantly, is longevity protection. I challenge the industry to come up with a solution there, Mark. If we could solve that, that would be the one thing I'd solve.
We're living longer. We're living longer, and we need the returns for it. It's a very good point. Welcome back to the program. If you have any questions about the bond or equity market, please pick up the phone and call on 1300 30 34 35 and the email yourmoney@skynews.com.au. I want to talk about portfolio diversification. I suppose that, I think this is a silly question in respect, but do you need to diversify? And if so, how do you want to diversify? How do you suggest that, clients should do it? And this is something I think a lot of clients will be asking you. So I think you've been kind enough to bring us some charts. And Jade, if you could bring up the charts that we were talking about. Here we have the first of the charts. Yeah. And, it reminds me of, the kids' drawings. So let's just go through, portfolio diversification.
For sure, Mark. This was just a simple illustration of the power. I mean, diversification is the only free lunch. Is the only free lunch in capital markets.
We love a free lunch.
This proves it.
Yep.
This proves it. So maybe.
So how do I read that?
Okay, it's a bit of a spaghetti here, but if your eye follows the red line.
Yep.
Pretend that's a security. We could call it a bond or an equity, and this is the rolling return of that equity over time. Good years, bad years. Average over this 5-year period, 7% per annum. Terrific, right? Good outcome. Other security, the green one.
Yep.
Ups and downs, just all over the place.
Yep.
Average return over 5 years, 7% return. You put half your money in one and half your money in the other, and you get that smooth, light green line. And do you know what your return is? 7% per annum, right?
Yeah. So, I mean...
And you didn't get any negative returns.
Yeah, and Dr. Stephen Nash from FIIG talks about this a lot. He talks about taking a long-term view on your returns, and if you have a smoothing out of this, the spaghetti as you're talking about, the benefit to you is you sleep well. You don't have that volatility. You don't have these massive movements. And it means you're just saying consistent returns over time have a very beneficial effect to your health.
Yeah, more than just sleep well though, Mark. Imagine if you had to retire in a down dip.
Oh, yeah.
As many people did during the financial crisis.
That's how Challenger makes all its money. It makes everyone look into the sky and say, oh my God, remember how bad it really was. And good luck to them for that marketing, because it struck true. I mean, I don't know how they'll do now in terms of that, what the next marketing piece is, but it's right that retirees got hit at the wrong time, and people learnt the lesson that if you lose 50% of your wealth, it's so much harder to make it back. If you're looking at 4% growth and you've just lost 50% in an overnight event, very difficult to make that back. You just don't do it, do you? And your retirement effect is terrible. Let's talk about asset allocation. Jade, if you'd be kind enough to bring us up another multicoloured affair. Do you want to walk me through?
Yeah, I'll walk you through this, Mark. So what we're looking at on the left is a kind of typical diversified superannuation fund type exposure with a mix of equity, mostly equities. It looks like a nice mix of assets: equities, bonds, real estate. We've got some alternatives in there. What I wanted to illustrate with this, if you actually look at where the risk comes from, that's the chart on the right, and it is absolutely dominated by equity risk.
So what you're saying, if I can understand this right, is that a lot of the equity that underpins all the different asset classes has an equity component, and therefore it creates an equity risk. In other words, if I buy a bond, the equity performance of the bond is going to affect the value of the bond. In other words, if the company goes down, the credit comes down, so it's pulling the bond value down. Is that what you mean by that?
Yeah, there's equity risk elements to some credit, and particularly in the high yield space.
Yeah,
for sure. I guess the illusion of saying I've got equities, I've got emerging market equities, global equities, I've got high yield bonds, I've got credit. It's all equity risk.
Yeah, but I hear all that and I get it. I think a lot of customers tend now, having woken up in 2008 and looked at their portfolio and they've got Japanese, equities. How did I get that? And, so many different products were sold to people in so many different times that they've got these emerging market things they didn't know and they're locked up and all that sort of stuff. And I just imagine that over time people have got more conservative with their investment portfolio, and it's much simpler. I could be completely wrong, but it feels that way to me. Is that the trend that you're seeing from your clients?
No. Well, it might be for self-managed super funds, for example, but certainly industry funds, corporate super funds, large public sector funds. If anything, they're pursuing more and more diversification, more moving parts, more alternative investments.
And is that because of the QE crowding out? There's not enough assets. They just can't keep buying. They can't put CBA up to $80. It just doesn't make sense.
Well, maybe that's part of it, but I really do think it is in pursuit of diversification. It's
not in pursuit of yield?
Without compromising return. That's the trick, right?
Yeah.
That's the trick.
I just think they're chasing yield everywhere. I don't know about you.
No, I think I'd agree in that our total return fixed income fund, for example, is one that investors are showing interest in because it's not necessarily correlated, certainly not with equities and not even with bonds. It's providing some kind of defensive alternative. So people are looking for homes, apart from diversifying, looking for opportunities to further diversify through new or
what
different.
What sort of returns is that fund getting?
Well, that's aiming to beat the RBA cash rate by 3.5%. So in the last 12 months, it's done just under 3.
Yeah.
So over cash. That's over cash. So 6 something over the last 12 months. So and that's what it's trying to do through the cycle. Importantly, not trying to just benefit from sort of asset classes like credit that are more correlated with equities. Trying to do that through the cycle.
So what will that invest in?
So that'll invest in a number of different, all types of fixed income investments, emerging market, debt, Asian fixed income, domestic Australian fixed income, floating rate notes, some inflation linked. So it's a really diversified pool, but it's forming views on whether, corporate bonds are going to underperform more risk-free Australian government debt, whether global bonds are cheaper versus domestic, whether the RBA is going to cut rates. So a number of different active strategies.
Traditional active.
Exactly.
So let's talk about diversity for you, because that's clearly a diverse response.
Yeah, sure.
And listen to what Simon said. I think you've been kind enough to bring in a chart as well. Jay, if we can just talk about FIIG's chart.
Yeah, we've brought this chart in. It's a chart we've been using.
We note the colour change. Simon the Wildman's only colour. So
this chart doesn't necessarily pertain to diversification as much as to really the idea of trying for your viewers to understand the fixed income asset class a little better in the short time that we have. So we basically look at fixed income here, looking at 2 risks.
Yep.
The horizontal one, I think many will understand the idea of credit risk. So the further to the right you might move from Australian government debt to BHP to a Fortescue,
to Greece.
The more risk to Greece. Yeah, you get more yield, but you take more risk. And that risk becomes, as Simon was saying, more correlated with things like equity market returns. High yield, for example, did minus 30% in 2008, let's not forget. The other one that's probably a little bit less understood is interest rate risk on the vertical axis, where basically this is the idea of interest rates falling means bond prices rise and outperform cash. So you've got that insurance. When do interest rates tend to fall? Economy is performing poorly, equities are performing poorly. You get that kicker by being in high quality, not the risky stuff, high quality fixed income over cash when you need it, when that equities are falling. And the point about this chart is that you can't have it all in fixed income in one investment. So you need to understand what it is. If you've got no equities in your portfolio, you don't need that insurance, so you don't need to be in that top left-hand corner.
Can't have it all. I love it. We'll have to leave it there. We'll go to a quick break about not having it all. If you have any questions for our expert panel, please call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. We'll be right back. Welcome back to the Bond edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Simon Eagleton, Head of Investments at for the Pacific for Mercer, and I've got Victor Rodriguez, Head of Fixed Income at Aberdeen. And we're in the last segment of the show, so if you have any questions, you can call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. SMSF. It's the fastest growing sector in the investment community, and the data numbers are 500,000 growing at by the end of this show there'll be another 400. It's just amazing. I worry from the perspective of, and you may all disagree with me, but I worry from the perspective of if you're an SMSF and let's say you're a plumber, you're a doctor, you're an architect, you're anything, postman, and you start becoming an investment analyst at 55 or whatever it might be, I'm worried about the challenge that you can perform in a way that, to Simon's point, you can deal with the longevity and get up to speed. So as market professionals, how, Victor, are you dealing with the education piece first? I mean, do you engage in that, or you just think, oh great, this is going to be free money, they'll just give me the money? How do you process that education?
No, absolutely. I mean, we're very, very active in educating the broader market. particularly on the fixed income asset class, but certainly across the range of asset classes that we manage. We've got, for example, we've released a series of investment fundamentals that really try and get people to understand what it is, how it is that you can add value in fixed income, what kind of asset classes in fixed income might make sense to you and so forth, and how they fit in a broader portfolio. So that education in SMSF land is absolutely critical. We engage with that sector without question, and it's the key point. And I think some asset classes may be better understood. You know, large cap equities, for example, there may be some understanding, but once you start talking about small cap equities, global type portfolios of investments, or fixed income, then the danger is that, like you say, people who are very, very capable but never spent any time in the investment sector looking to sort of
also they become very time poor. You want to retire, you want to enjoy your retirement, and you think, okay, I'll spend an hour on a Monday and go through my investment portfolio and find out that it then just morphs into some bigger issues. And
the things that worry me, Mike, is really what we talked about before the break, was diversification and poor diversification in those funds. And your last point there about, and particularly where you set up an SMSF in retirement, and then maybe the husband dies or becomes too ill to manage.
To be able to manage, you end up with the money, and you've done it for the last 20 years, and you don't have an investment advisor.
That's right.
Your partner is left with all these problems about how to look after his or her longevity. And on that point, we're going to have to leave it there. But thank you very much for both coming on. It's been great. That's all we have time for at the moment. We have much appreciation to the guests we've had: Simon Eagleton, Head of Investments for the Pacific for Mercer, and Victor Rodriguez, Head of Fixed Income for Aberdeen. And to you and the viewers, enjoy your weekend. Until next week, I'm Mark Todd from FIIG Securities. Have a great Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.